On this week's episode, we're going to talk about a couple of different investment types that have boomed in popularity over the course of the past several years. But at the end of the day, based upon some most recent research that sort of harmonizes with things that we've been talking about on this program over the course of the years, you might not want to have these particular types of investments in your portfolio, or at the very least, if you do, make sure you're kind of double checking what value they are actually bringing. And then we thought we would also share some of the specific examples that we've encountered just in sort of our day-to-day practice of helping people organize their finances. Some specific examples of times when it was incumbent upon them to review and change and adapt their estate plan from an overall perspective. So that is on tap for today. But of course, before I forget, I have to wish all of the mothers out there happy Mother's Day. This, of course, is Dollars and Cents, where we help make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations in the podcast universe as well. To find our channel on any of those platforms, including our YouTube channel, where you get to see us do this show in all of its splendor at the Nelson Financial Planning Studios, located at our office in beautiful Winter Park, Florida. Go to our website, nelsonfinancialplanning.com, and you'll see a bunch of icons. Those will lead you to the promised land of our channel on the platform that you are looking for. Once there, make sure you subscribe, and then that way you don't have to go through that all again. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who, if you are a regular listener to the program, you know that they join me on a regular basis here on the program to often talk about areas of their particular expertise. We use a team-oriented approach at the firm Nelson Financial Planning, so you get a host of experts in which to help figure out and solve your financial concerns. Very unique. We're not one of those silo structures where, I came in, I talked to Kristen, or I talked to Joel, or I talked to Rob, and that's all you get to talk to. No, you get a team approach with Nelson Financial Planning. So certainly, let me take an opportunity to further emphasize what I said before, which is Happy Mother's Day to all the mothers out there. The original air date of this program is Sunday, May 11th. So, of course, I'm going to take an opportunity because, it's my show, so I get to do this. I want to wish Stephanie a very happy Mother's Day on behalf of our three sons, Nelson, Ethan, and Connor. Of course, Mother's Days these days, and for that matter, Father's Days as well, come a little bittersweet because all of the kids have, in essence, grown up, moved away, finishing up college. Actually, two now one has finished, and one here next week will finish college. So we'll only have one left doing college days, if you will. So they've all sort of kind of grown up as expected, right? That's, kind of the pattern. And so not in the area for Mother's Day. So needless to say, a little bit quieter, if you will, than it used to be. However, both Stephanie and I are very blessed, very fortunate to have the opportunity to spend some time with our mothers later on today. So as life would have it, both of our mothers are still with us, so that is good. And obviously in the area, so an opportunity to spend Mother's Day with them. So certainly hope that you and yours have that same opportunity as well. A little history about Mother's Day, because that's always kind of what we like to throw in when we talk about certain holidays. Particularly, it seems like the show always kind of has a tendency to fall on a bunch of holidays because it airs on Sunday. So that always catches Easter and Mother's Day and Father's Day and probably a host of other holidays I can't remember right now. But Mother's Day celebrated here in the United States on the second Sunday in May. Holiday was first celebrated on May 12th, 1907, when Anna Jarvis held a memorial service honoring her late mother in Grafton, West Virginia. Miss Jarvis led a campaign at that point, thereafter, after she did this service for her mother, led a campaign to establish a holiday that recognized the importance of mothers to their families. Her efforts were obviously successful, and within 5 years, virtually every U.S. state was observing Mother's Day. And then in 1914, U.S. President Woodrow Wilson made it a national holiday. So there you go. Little historical background on Mother's Day. Speaking of mothers, and this is a much more kind of somber note, but if you're a regular listener to the program, you know that I am the primary caregiver for my mother, who is now in assisted living. And obviously, if you're familiar with what that means, then you get the struggles that come with that, particularly because hers is a very cognitive based or cognitive decline that's happening, unfortunately. So, and so one of the things that you struggle with is, okay, well, what happens when, what's the best way to kind of get organized for that? And so this past week, in fact, I decided that it was time, and I had talked with my sister. She lives on the West Coast, not the West Coast of Florida, the West Coast of the U.S., out in Seattle. And so we decided that, okay, it's probably time to just go forward and ultimately do sort of a prepaid burial plan kind of thing. And don't get me wrong, normally I'm not a big fan of anything kind of prepaid, right? But given the realities of someone of that age and in that health condition, might be something to certainly consider if you find yourself in a similar position of being that primary caregiver. I'm not sure. We're not going to present this as the Mother's Day gift. Really, that's a bad idea. But there's certainly some value to the process and what needs to be done and what needs to be called that I wanted to just kind of share with you, because it was sort of top of mind, because literally I just did it this past week. And so the benefit, if you will, is it's done, right? And so you're not going to have to then have one more thing on your plate that you've got to do when you're grieving with the reality of someone's passing. I mean, literally, when you do these prepaid plans, they'll ask you, do you want to be buried? Do you want to be cremated? Where are they living now? Who to call? All of those kinds of things. All those details sort of get worked out, and it really then boils down to, you just need to kind of make a phone call to the funeral home, and sort of everything happens then automatically. And the other part, of course, is during the summer months, obviously the kids are away. And so, we'll certainly be traveling to see them. I go to a variety of conferences, particularly during the summer months. And so I was concerned that, something could happen while I was away, and sort of what could be done. And frankly, it was much simpler than I thought. Called and got an appointment, and obviously gave them some initial information, name, address, things like that. And the reality is that, less than 30 minutes to get everything wrapped up and accounted for. But the good news is that years ago, when my mom's significant partner had passed, then we had sort of some of those, those conversations. So it wasn't like we had to go through this whole decision-making tree. So we kind of knew what we needed. But now that we've got the prepaid, now we know, hey, it's just one call. We don't have to kind of go through, run around, figure out how to get an appointment, all of those kinds of things. And, I guess the reason that I'm sharing this with you this morning on today's program is that I do think it was a useful exercise that ultimately helps to make things a little less difficult during what obviously will be a difficult time. Now, I guess one of the things that I thought would be interesting to share with y'all is what the sales rep said to me as we were wrapping up my mom's prepaid. And so we're going to share that, but we're going to have to wait for that until after these messages. So stay tuned here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're kind of sharing something that we did this past week, and that is went out and got a prepaid burial plan for my mom, as I shared with you earlier in the program. If you're a regular listener, you know that I am a primary caregiver for my mom. She is 84 with pretty significant dementia in assisted living now. And so at the end of the day, as we were kind of thinking of what are some of the things that we need to do, one of those things that came up was, well, if we happen to not be in town when something happens, whether that be for traveling to see the kids or on away at a conference or something like that, then how do we kind of navigate that? Like, what's the best way to sort of handle that? And the more I was thinking about it, the more I also thought, well, even if I was in town, to get one more appointment on the calendar during a period of time where life becomes sort of a blur when you lose a loved one, I think that's, I guess, one way to describe it is it all becomes a bit of a blur, I suppose. And so you want to make sure that you're making good decisions, and certainly by doing a prepaid burial plan, then at the end of the day, you do wind up having that all taken care of when you might not be as blurred in terms of your vision. So went to one of the larger funeral homes here in town and got all of that squared up this past week, which certainly makes sense for someone of that age and that health issue. Here's where I got a little kind of curious or funny, if you will, and that's when we were kind of all done with my mom and all of that wrapped up and just kind of waiting for the papers to print, and out the door we went. The sales rep, and I guess that's what you would call him, even though it is for some burial plan, their sales rep says to me, well, now that you've taken care of your mom, what about you? And I said, well, I think we're going to pass on that today, although certainly tomorrow is not guaranteed for anyone. The reality is that that then starts to go back to what makes sense from a financial perspective, right? And when you start thinking about the time value of money, and the reality is that I've certainly never been a fan of spending a bunch of dollars today as sort of an inflation hedge, if you will. That isn't just one that I think is a very good financial decision. And certainly I appreciate his sales technique. He brought up all the uncertainty of you got tariffs, and I'm like, well, if I'm just going to be shoved into a big fire and turned into ash, well, I don't know that tariffs necessarily impact me, but okay, fine. He brought up all of that stuff, raising the cost of things in the future. And, for the vast majority of prepaid stuff, whether it's college prepaid or prepaid funeral or any of that stuff, it really is just your return is effectively based on inflation. So just not sure that that's necessary if you're kind of playing the law of averages that far out. But the other part that I did want to share about this whole experience, which I thought really was actually good, is that they shared with me a planning guide that really was a binder of information that I thought is really quite useful. And it's some of the things that we've talked about on the program over the years. But to make sure that you are writing that stuff down for your beneficiaries or those that will be behind when you pass, or at the very least sort of having a conversation about the more pertinent parts. So this planning guide, as I was kind of flipping through it, it really was relatively useful. It had sort of important information and sort of fill in the blank about your life history, your family history, and that's certainly important to have that general information, particularly when someone's going to be creating your obituary, and it's obviously a good idea to have a record of family history as well. Trying to write an obituary from scratch, certainly not an easy task. So they sort of had a fill-out form of different questions. What's your career accomplishment? What's the best thing you ever did? Those kinds of things. And so I thought there was some good questions in there. And also asked questions about your service preferences, and of course a detailed list of people to contact at your passing. That also includes their contact information, things like phone numbers, addresses. And then of course the notion of using this planning guide is that you have all of your pertinent information in one location, so that your will, your will or your executor and your attorney, certainly having good information and contact information for those folks, plus all of your different financial information, your banking, your credit cards, things like that, whereby all of that is in one place. That allows people to certainly easily access that, and more importantly, log in to things once you are gone, and particularly, I guess, in today's world, and having those logins and profiles and electronic storage of all of those records is pretty important to make sure somebody knows how to get access to that stuff. So I thought I would just sort of share that personal experience with you that we went through this past week, the process, and those useful materials that you should really take the time to complete to make sure that you have all the right and pertinent information in one accessible place. So just kind of wanted to share that sort of story with you all this morning. And then shifting gears, as we like to do here at the beginning of the program, although we're about halfway through the program now, the reality is, as there always is, there were some headlines this past week, and certainly a busy week headline-wise for two hot topics, both on the interest rate side of things and the tariffs. So we want to take some time and talk through that and what it means for your money. On the interest rate side of things, the Fed decided to hold rates steady for the third consecutive time this year. While they certainly took note of the increased risk to higher unemployment and higher inflation, particularly due to the uncertainty over tariffs, the actual most recent economic data, and we shared with you the latest labor report on last week's program, the latest economic data on unemployment and inflation doesn't really show a major impact. The risk, of course, is that the Fed could find themselves behind the curve, meaning those things all of a sudden jump up or get worse, and the Fed needs to then start to quickly cut rates. But certainly for now, and as we predicted on the program a couple weeks ago, they stood pat in this May meeting. The reality is that the Fed does meet 8 times per year, and the next one comes up actually relatively quickly in mid-ish June, and that could be the one where you see the Federal Reserve join other central banks that have really started to cut rates as well. So why is what the Fed does so important? Well, if rates stay as they are, that's good if you've got money sitting in a high yield savings or a money market type of account. The flip side is if you owe money, particularly credit card companies, or if you're looking to borrow money anew, courtesy of a mortgage, then you're going to pay a little bit higher interest rate. And so any change in the Federal Reserve rate obviously will help to push those rates down when they cut those rates. So depending upon kind of the situation, a change in Fed rates can really kind of cut both ways, good and bad, depending upon your personal situation. Our expectation remains that you probably will see a couple of quarter-point rate cuts between now and the end of the year, and that will be good to help reduce down the borrowing costs for people. Certainly one way to stimulate economic growth. Tariff side of the deal, it was announced that a deal, or I guess a framework for a deal with the United Kingdom was occurring. Obviously, I think much of the details need to be worked out. But what became, I guess, maybe a little bit more apparent than certainly a month or so ago was that the direction of U.S. trade policy is ultimately to come to an agreement or to start cutting these deals, which is sort of a stark contrast from a month ago. Couple that with a meeting with China about trade as well in Switzerland, and it certainly seems like things are kind of in a very different direction than when where they were just a month ago. So we will continue to update you as things progress, as we always do here on the program. We're going to slide to a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. A lot going on this past week. We were talking about the Federal Reserve meeting and also the change in, or at least the announcement of a framework of a tariff deal with the UK. Of course, the other headline out of Europe is new Pope. Actually, it wound up being an American, the 267th Pope, which got me thinking, well, when was the first Pope? And I guess that would have been probably right around like AD 30, 40, somewhere around there. And the longest head of government state, currently the 267th Pope that got elected this past week. And then extremely closer to home at the office at Nelson Financial Planning, we had a very successful Community Shred Day event this past week. Don't have sort of official numbers on that, but we estimate probably a couple hundred people participated on our Wednesday morning shred event at the office. A great opportunity, I guess, to get rid of in a secure fashion or to properly dispose of your personal financial information. It's an event that we started holding, I guess, 2 or 3 years ago now. And now we do it on a regular basis, actually twice a year, one in May, which was the event this past week, and then one in December. Hopefully the weather will be a little bit cooler in December because it was kind of toasty out there this past week. But anyway, we appreciate all that participated in our Shred Day, and certainly it looked like it got a nice response from the community as a whole. So happy to do that as a valuable community service from our office at Nelson Financial Planning to yours. In this segment, we're going to talk a little bit about two particular types of investments that you need to be very careful with, particularly as a result of their internal cost and their tendency to be very leveraged. And what that means is they borrow money to sort of amp or juice up the return, or to be very sector specific. So the first category that we're going to kind of talk about in this segment is this notion of hedge funds. And the second, in fact, is ETFs, which many people assume are some of the most cost-effective types of investments. But according to Morningstar, at least, that might not actually be the case. A lot of ETFs may actually be more destructive of value than constructive of value, at least based on the most recent research by the folks at Morningstar. So we're going to start with the hedge fund side of things, which clearly have exploded in assets over the course of the past 25 years. In the year 2000, it was about $200 billion that was held in hedge funds. Today, that number is $6 trillion. So big increase in the amount of assets that are held in hedge funds. Where you see it particularly having grown is inside of institutional money. So things like pension plans and the like, those are where more of those dollars are coming from to feed into these hedge funds. In fact, 7% of all public pension funds are invested in hedge funds. So things like the state of Florida retirement system, things like that, those would be the types of plans that would have a significant portion of money invested in hedge funds. And then large endowments as well. Almost 20% of those assets are held in those types of hedge funds. And I suppose it's sort of the cachet of owning a hedge fund, right? And I own a hedge fund, and that because the hedge fund world was always sort of reserved for the super elite and wealthy, and that was how they were investing their money. Problem is that most hedge funds don't necessarily have the kind of returns as what they used to, simply because it's much harder to find those needles in the haystack these days, especially with the massive flow of information. And certainly based on the most recent research, and this was published in the Wall Street Journal earlier this year, over the course of the past 2 decades, fees in hedge funds have amounted to more than 50% of gross gains. In other words, over that period of time, according to research by the Wall Street Journal, hedge funds earned about $3.7 trillion for their investors, but kept nearly $1.8 trillion of that $3.7 trillion in the form of fees. The worsening of those fees to gains represents how hedge fund returns have in fact moderated in recent years, simply because it's harder to find those more unique opportunities, especially with the speed with which information flows these days. So what you're seeing in the hedge fund world is the returns aren't as good as they used to be, just generally across the board. But unfortunately, even though the returns aren't as good as they used to be, there hasn't been any reduction in fees, and in many cases, the fees have actually crept higher. Many hedge fund firms take a management fee of 2% plus a performance 2% per year plus a performance fee of 20% of fund profits. That's right, 2% per year plus 20% of fund profits. Some places charge even more than that. As you might well imagine, that's sort of a significant drag on performance. And what was funny about the research is that it's nearly identical to my personal experience with owning this type of investment. And we've certainly shared the results in prior shows of that. Where that comes from is one of the sort of the fundamental tenets at Nelson Financial Planning is that our clients don't own anything that we don't have our own personal money in. So what that means is that from time to time, as products evolve and become more available to the masses, like these things like hedge funds, for example, then we feel it incumbent, in order to make sure that we're providing the best possible investment recommendations to our clients, to actually take and put some of our own personal money at risk to really get a better understanding of exactly how this stuff works. Because let's face it, folks, when you do it with your own money, you pay a little bit more attention. And so that's something that we've always done. And certainly we would say that we want to be learning with our money and not our clients' money, which I guess should be kind of appealing to everybody, right? You don't want me to really learn with your money, so to speak. So this was probably 10 years ago. Invested about 50 grand in one of these, not about, it was exactly 50,000, because that was sort of the minimum investment, and into one of these kind of hedge fund-like types of investments, and certainly shared the results of how all of that went on prior programs. But when the fund closed out, which now is like probably a couple of years ago now, and at the end of the day, our actual return over that holding period wound up being less than 5%. And what was always confusing is that on the marketing papers, or in the final report that I got, it said, well, the IRR, okay, which stands for internal rate of return, was 9%. That internal rate of return doesn't mean anything, because that's like the gross return. The net return is what you get. It's almost the same kind of thing as what we were talking about here a couple weeks ago, in terms of how the annuity people kind of manipulate the numbers to make it seem like you're getting a better return when you're really not. Because in the annuity case, they count the original investment coming back to you as part of your quote-unquote return. And at the end of the day, that's not really your return when you're getting your own money back. The reality is that it's kind of the same thing in the hedge fund world, except I guess it's slightly different, where they talk about the IRR, the internal rate of return. But the internal rate of return doesn't mean anything to you, because you're not internal, you're external. They're the one that's going to get the net return, and ultimately that's the piece that ultimately matters. And at the end of the day, much like my personal experience, nearly matched exactly what the Wall Street Journal research had done, because in fact the fees did in fact consume half of the return, which means that you're not getting nearly what you thought. So if you have a hedge fund or a hedge fund like type of investment in your portfolio, be very careful. It may be typically described as an alternative investment. Those have become, that category of investments has become all the rage when people say, oh, you need to have an alternative part of your portfolio. at the end of the day, it might not be adding a whole heck of a lot. We're going to take a break. We got some final thoughts on this, so stay tuned with us through the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about a couple of the investments out there that you probably want to be very careful with in your portfolio. What we were talking about before the break is this notion of these hedge funds, often considered sort of alternative investments, get pitched a lot about them as, oh, you need this in order to expand out the diversification of your portfolio. And that's fine. And I'm not saying that your portfolio shouldn't be diversified, but sometimes the concept of diversification can also come into play, because if you have these types of alternative investments and you just have them in the portfolio because they're different than what you have, the reality is, though, that the question that you have to ask is, well, what value is said diversification actually going to bring to the table? And the example of these types of investments, these hedge funds types of investments, these alternative investments, as we were talking about before the break, the fees typically will consume half of the return. That was certainly our personal experience when we chose to sort of do a educational exercise to see how those things worked with our own personal money about a decade ago, which finally closed out here, like we said, about 2 or 3 years ago. The IRR that was advertised through all of the promotional materials right to the very bitter end was this was a 9%er, okay? Yeah, not exactly. It was not a 9%er. The reality is that it wound up being half of that because the institution took half of it in the form of fees, which basically, as we said in the prior segment, mirrors the research out of the Wall Street Journal, which concludes that the hedge fund industry as a whole, about half of the return that is generated for its clients got consumed up in the form of fees and expenses. So be careful with that. And then also saw this analysis from the folks at Morningstar naming the funds with the worst performance record in terms of dollars over that past decade. This was a recent research report by the folks at Morningstar, came out at the end of April, naming the 15 worst performing funds. What was surprising, if you will, about that list is of the 15 worst performing funds, 13 of them were ETFs, or exchange traded funds, which have become very, very popular over the course of the past decade in the industry. The reality is that a lot of exchange traded funds out there can be highly leveraged, which means they're borrowing money to sort of juice up the return, or they can be very highly sector specific as well. That can be a very potent combination for you to potentially lose a bunch of money. And as the Morningstar list shows, and even Morningstar commented, certainly provided a valuable case study in how not to invest. So bottom line, don't necessarily be fooled by the use of ETFs inside of your portfolio. Oh, right, they're low expense, blah, blah, blah. But it depends on the type of ETF that you have. They can certainly do a lot of value destruction as well, rather than value creation. So interesting stuff. I guess at the end of the day, it always comes back to something that we've always said for years and years and years on this program, which is know what you own. Okay, know the nature of it, what it is, what it's there for, how it actually works, what's it bringing to the table, what the underlying costs are, all of that. Pretty important stuff when it comes to knowing your investments. So some interesting latest research, if you will, on that area. Wanted to take some time now and talk about some of the instances where you want to sort of stop and maybe update your estate plan. Much like your finances, it shouldn't be a sort of set it and forget it type of option. You should be viewing this, your estate plan, as sort of a dynamic plan rather than a static one. And so this remaining part of this segment is sort of directed to those folks that actually have an estate plan. So, but let me at least start with this statistic. Only about 1/3 of Americans have done a will. So let me take a moment and talk to the 2/3 who haven't done anything at all. You should do that. Just something, right? In today's world, you can find simple wills, simple forms online that at least will get something done in terms of some form of an estate plan. Now, if you have an estate plan, clearly there are some circumstances that really should trigger you updating that estate plan. The reality is anytime you want to change anything in an estate plan, it's got to be done the right way. And it has to be, typically that means you've got to have documents witnessed, you've got to have documents notarized. It's crucial to make sure it gets done the right way, because if it gets done the wrong way, then it doesn't count, if you will. So we've got 6 different ways or 6 different scenarios where you probably want to look and say, hey, I need to blow the dust off of my estate plan and maybe make some changes. First, obviously, is this any change in your marital or family status, right? You get married, you get divorced, you have another kid, whatever the case may be. You've all heard the stories, right? Where the ex-spouse winds up inheriting the life insurance or inheriting the house or whatever the case may be, because the estate plan was not changed to reflect the fact that those folks weren't married anymore. Another gap, if you will, in that scenario is the naming of beneficiaries as well. So you got to make sure when we talk about estate plan, we're talking about not just the documents like the will, your trust, or your power of attorney, but also accounts where you are naming beneficiaries and checking out and verifying those beneficiaries that you've named on those accounts. It is as important as anything else. So make sure you're checking that out, particularly with a change in marital or family status. Another situation where you may want to revise your estate plan is any sort of major life change for a beneficiary. Now, that could maybe mean that a beneficiary predeceases you, but it also could be that a beneficiary or even a decision maker, whether that's your executor or your POA, maybe has a health issue or a disability issue. Those are the kinds of things where you would certainly want to modify sort of what the plan is, or worse, someone develops a substance abuse problem later on in their life. Those all would warrant potentially making a change in your overall plan. Another scenario is if you move to a new state or new country. According to the Census Bureau, more than 1.2 million older adults cross and move over state lines every year. Beyond that, 760,000 Americans are receiving Social Security payments while living internationally, according to the U.S. State Department. So reality is, state laws can certainly vary, and your will is still going to be valid in another state, but it may not be as optimal in terms of the outcome that you desire if you do, in fact, move to another state. If you live in a different country, hey, all bets are off. So you really want to do some estate planning if you're living in a different country. Similarly, if your assets have increased in value, right, maybe your beneficiaries can't necessarily handle those larger amounts that might be coming their way. And so it might be a good time to sort of add some guardrails into that process. Or maybe you've now got the flexibility to leave money to other people or causes that were more important to you. What are we up to? Number 5, if you change your mind, right, you can about something or someone. Life has a way of changing people and things. And so it doesn't mean that any decision is etched in stone. I remember when Stephanie and I updated our state documents here a couple of years ago, we looked at it and we're like, wait a minute, we don't go to church there. We don't go to church there anymore. Like, we got to, so it's those kinds of things that just happen along the way. And then lastly, which goes to just kind of the rule of thumb, if you haven't looked at your estate plan in the last 5 years, the reality is life changes and the law changes as well, relatively on a consistent basis. So you certainly want to take a look at that and make adjustments, particularly this year, right? A lot of conversation out of Washington in terms of potential tax changes and things like that. So certainly some things to be thinking about when it comes to your estate plan and how best to approach it, and particularly know when you need to take another look at it and ultimately update it on a regular basis. So we want to conclude by extending wishes again for all of the mothers out there to have a happy Mother's Day. Next week on the program, we're going to be out of town because our middle son is graduating. So 2 out of 3 fully graduated, and in theory, sort of off the payroll. So next week, our hosts are going to be Kristen Costello and Chet Cowhart of Nelson Financial Planning. So make sure you listen on in to their program. With that, we're going to wrap it on up and get on out of here. This is Joel Garris of Nelson Financial Planning. If you're interested in finding out how we can help you, visit our website, nelsonfinancialplanning.com. Thanks for listening.